Hi, my dear learners. Today we just think over how the money is invented. What is the reason behind that? So just imagine. So today we have the n number of the currencies, different denominations. It may be the paper currency, or it may be the digital currency, or it may be the Indian rupee, or any other foreign currencies. But what are the major reason behind that to introduce this type of the currencies for the transaction purpose? It is the major tool for the economy. But how, as a human being, what are the reason behind that? Why the humans invent currency? So first we should think that the money is the big idea, right? So it changes the huge in the economy. It changed the lifestyle of the common man or the any human being. It gives the n number of the opportunities. So it is a big idea. But what is the reason behind that? Who introduced this big idea in the society? Why the money matters a lot? The history of money is not just about the coins and banks. It is a very thrilling story of how people invent tools to manage risk, grow their wealth, and trade across the globe. Every time money changed, society changed too. We will track this journey from ancient civilization period to today's digital currency. So if you go through this image, it shows that the ancient medieval period to early modern and modern era. So why the civilization period, or how they introduced this type of the financial transaction benchmarking for the economic growth or for to minimize the risk levels and all those things. This graphic is clearly shows the stages of financial history from ancient trade to modern digital money. It gives us the map for our journey. The first financial invention, or it also called as in the ancient or medieval foundation, when temples were the first banks, what happened in the ancient Mesopotamia? People realized their harvest, like grains or any food items, needed to be kept safe. They began storing it in the temples and palaces, which became the first secure depositors. So, in this period only, in the Mesopotamia civilization period, so we identify the first loan concept. A farmer did not just store grain, they could also take a grain loan. The extra grain they had to pay back was called interest. This basic idea of a loan is what still powers banks today. So this image shows a tablet with the world's first financial records, providing the banking started with writing down debts and deposits. Around 6th or 7th century BCE, the standardization of money concept will take place. The move from commodity money like cattle or shells or any other food items to standardized metal coinages. Trading a sheep for three baskets of dates was complicated. So that system we call as the barter system. The barter system is always the confusing, it is complicated and unstandardized. People needed something everyone agreed had value. So that's why they introduced the standardized currency they called as in the coins. In 7th century, at the time, the economists they made a small metal disc with a consistent weight and stamp, the stamp of the kingdom or the emperor or a ruler. Now a merchant could travel far and wide, knowing their gold coin would be accepted everywhere. So this is the beautiful coin as one of the world's first standardized currencies. It represents a huge leap that made trade easier and faster. The medieval solution to travel risk. When the people they are traveling from one place to another place with carrying of the gold coins, it is very risky. So that's why the development of instrument to facilitate trade and bypass the danger of transporting the metal money like the gold coins. So that's why the carrying heavy bags of goods from Florence to Venice or from one nation to another nation or one place to another place was slow and dangerous because of the pirates. That's why they introduced the concept of the bills of exchange. That is the solution. Merchants invented a paper contract that said, I promise to pay you the XXX gold pieces of coin. This paper was safer to carry than the gold itself. It was the ancestors of modern checks and wire transfers. So this image shows that the two merchants they are shaking hands over the bill of exchange. This piece of paper meant they could trade across continents without risking their lives transporting heavy metals. The age of exploration and early capitalism. Financing highly expensive and risky venture requires pooling capital from numerous investors. Just imagine sending a ship to Asia from America to buy spices was incredibly expensive and risky. If you owned a whole ship, you could lose everything. That's why they think that the midway for that concept is the giant shark company. Investors decided to pool their money to buy a teeny piece, a share of a big voyage. If the ship sank, they only lost their small share. If it succeeded, they all shared the giant profit. This is the birth of the modern corporation. This image shows that the Dutch East India Company VOC, they were the first to truly sell shares to the public. It was groundbreaking way to raise huge amount of capital. This is the first certificate in the whole world, first stock certificate. It shows how ordinary people become the owners of massive global company by buying just one share. the global marketplace, or the centralized trading and risk management system. The need for a formal central location to trade these new shares and other financial contracts. So just think that if you want to sell your shares quickly, or if you want to buy any shares or any financial instrument, so where you should sell these instruments or where you can buy the instruments. That's why they create the platform. That platform they called as in the central meeting place. That central meeting place is generally called as in the stock exchange. In early days, London Stock Exchange is only the place for buy and sell the financial instruments like shares, bonds, and promissory notes. But in later stages, n number of the stock exchanges give the platform for buy and sell all the financial instruments, including the hybrid instruments. This visual aid shows that noise and excitement of the investors. This image shows an the early trading floor, the central spot where buyers and sellers gather to make the emergence of public finance, fighting wars and building ports like the airport or the harbor, special defense platforms, research and development, or aviation projects or astrological projects. It cost a fortune, right? The same way, in historically also, the kings could not just ask the people for gold every year. That's why in 1694, the Bank of India was created, primarily to manage the government debt. They invented the modern bond, an IOU, where the government promises to pay you back plus interest. It means that the principal amount and what you are invest plus interest. This was the start of national debt and central banking system. So this is the original Bank of England. It looked solid because it has very serious job, the managing the country's money and its promises to pay back the investors. The Industrial Revolution and 19th century, the rise of the investment bank, the need for the massive capital to fund railroads, factories, and industry led to the specialization of financial firm. The Industrial Revolution requires a huge amount of money to build factories, to construct the railway tracks and steel mills. Individual wealthy family or the small banks could not fund these massive projects alone. Powerful bankers like JP Morgan stepped in. They helped the companies issue shares and bonds to the public, gathering the capital needed to build America's industries. These investment banks were the gatekeepers of growth. A portrait of JP Morgan representing the power and influence of the early investment bankers who financed industrial expansion. The gold standard. a system to ensure stability and liquidity across international markets. Many major countries tied their currency directly to a fixed amount of gold. This meant one country's money could always be converted to another's at a predictable rate. It kept prices stable and boosted global commerce. A simple graphic showing how the gold standard linked national currency supply to gold reserves, promoting exchange stability. Without the rules, the system often failed. The panic of 1907 saw investors lose faith, leading to bank runs and economic crisis. JP Morgan himself had to step in as a private individual to bail out the system. The Federal Reserve in 1913, America realized it needed a permanent safety net. The Fed was created to manage the money supply, act as the leader of last resort, the bank for the banks, the stabilized financial system. The historical newspaper clipping to illustrate the public and systematic impact of unchecked financial, a Great Depression and new roots. The stock market crash of 1929 and the resulting Great Depression showed that the system was fundamentally broken. Banks failed and people lost all their savings. That's why the government stepped in with the regulation. The US established FDIC and SEC to regulate the stock market, FDIC to ensure the deposits. The new rule, that rule is maintain the transparency and protection for average person. That's the building of Federal Reserve building of the exterior. After the World War II, the world needed a stable system for global trade without returning to the risky global standard. Just imagine this. After the World War II, huge depression in almost all the nation's economy, huge distraction in the financial instabilities, no proper traded commerce, no proper standardized export and import. At that time, in 1944, Bretton Woods Conference established the US dollar as the world's reserve currency, backed by the gold. This created decades of predictable exchange rates and massive global growth. It also led to the creation of IMF, International Monetary Fund, and the World Bank. The photo of the Bretton Woods Conference of 1944, where leaders established the post-war global financial order that powered economic growth, for decades. The rise of academic finance. Finance emerged as a distinct, rigorous academic discipline separated from the economics, using mathematics to solve real world investment problems. Before the mid 20th century, investment or the investing was often based on guesswork. Markowitz changed that with the modern portfolio theory, that's called as an MPT. You should not just look for the high return. You should focus on minimizing risk for a given level of return. Modern portfolio theory uses maths to show investors the most efficient mix of assets like stock, bonds, or any financial instruments. The Markowitz modern portfolio theory graphics we deeply discussed later related to the modern portfolio theories, how we should select, how we should create the portfolio, and how we should plot it according to the MPT. Modern finance, globalization, and digitalization. Financial engineering and globalization. This is the proper terminology to explain this context. As the market grew, the shares, bonds, or financial instruments market, when the market grew day by day, so did the complexity of risk also increases. Companies needed way to insure themselves against the future changes in things like the interest rates or the commodity prices. Means they want to minimize the risk of the future prices or the interest rates. That's why they introduced the new financial tool, that tool called as in the derivative. These are the financial contracts whose value is derived from an underlying asset, like oil, a stock index, or a loan. Tools like interest rate swaps allowed companies to hedge or neutralize the financial risk. The basic flow chart showing how two parties exchange fixed and floating interest payment in a swap agreement, a key tool in modern corporate finance. A great financial crisis in 2008. While the derivatives were powerful risk management tool, they were also used for the massive speculation. The financial engineering around subprime mortgages created a toxic web of the debt. The event of 2008 global financial crisis revealed that interconnected financial institutions could bring down the entire system, providing that financial innovation requires strict oversight. So, a chart showing the dramatic rise and fall of US home prices leading up to 2008, illustrating the speculative bubble that causes the global crisis. The fintech revolution and cryptocurrencies. Technology is now fundamentally changing how we use money. Financial technology is making banking services faster, cheaper, and more accessible through mobile app and AI. The biggest challenge to traditional finance is cryptocurrency and blockchain. For the first time since the Lydian coin, investors are proposing a form of money, Bitcoin, and record keeping, blockchain, that exists entirely outside of banks or government. This marks a truly new chapter in the history of finance. The graphic combining the icons of mobile banking, blockchain, and AI representing the key trend that define the future of money, fintech coins, and crypto logos. We are at the end of the session. The history of finance shows that money is an invention, not a force of nature. Every tool, from the Mesopotamian tablet to the blockchain, was created to solve a specific problem: how to share the risk, facilitate the trade, and store value. Invention is constant. People will always invent new ways to use money. Risk require rules. Every great invention is eventually followed by a crisis, forcing us to create new laws to protect the system. The takeaway from this session is innovation is constant, risk requires rules. Thank you. If you are interested about this type of the videos about the economics, financial management, or any other commerce domains, share and subscribe to this channel. Thank you.